The live intraday trading price for BigBear.ai Holdings Inc, under the ticker symbol BBAI, stands at $4.39, showing a steady upward shift of 0.46% during today's trading action as institutional buyers quietly accumulation shares near key support lines. While most retail investors are looking at massive tech names to catch the next wave of corporate computing, the real action is happening in specialized, high-consequence environments where a single miscalculation could compromise national security or halt global shipping operations. Right now, this specific stock is executing a structural shift that almost nobody on mainstream retail platforms is talking about, creating a massive discrepancy between what the broader public believes this company is worth and what the defense infrastructure actually requires. When you think about big software allocations, names like Nvidia stock or Tesla stock usually dominate the conversation, but the quiet growth in federal backlogs is starting to point to a completely different corporate reality. If you check online investment sites or open up your Fidelity brokerage account, you might just see a volatile microcap name, but under the surface, a major contract expansion is fundamentally altering the balance sheet. The general market expectation for small defense-focused software firms is that they are perpetually unprofitable cash burners that live or die by lumpy, unpredictable government purchasing cycles. Mainstream financial commentators often warn that without mass-market consumer software, smaller intelligence operators cannot scale efficiently, leaving retail traders to seek investment help through automated options like Schwab Intelligent Portfolios or generic self-investing platforms. The dominant narrative tells us that unless an intelligence firm is the size of Palantir, it simply cannot survive the rigorous capital demands of modern machine learning infrastructure. However, the ground reality is completely rewriting that narrative because small, nimble software providers are increasingly winning hyper-specific, mission-critical tasks that the massive tech conglomerates are either too slow or too politically compromised to handle. By securing targeted niches in maritime shipping compliance and automated border intelligence, this firm is proving that specialized execution matters far more than massive consumer market share. When you track the daily swings in options volume over the past 48 hours, you see a sharp spike in call options activity, with volume rising more than 60% above the historical average. This type of unusual options activity typically signals that institutional funds are positioning themselves ahead of a broader public realization regarding the company's revenue trajectory. In the current macroeconomic environment, where rising interest rates make speculative technology look incredibly dangerous on a Robinhood stock trading app or a standard individual brokerage account, actual contract visibility is the only metric that matters. The company recently reported a backlog expansion of 14%, pushing its total unfilled contract base to approximately $282 million, which provides a massive buffer against near-term economic slowdowns. While people are busy staring at the daily volatility of Apple stock on their Fidelity mobile app, Smart Capital is tracking how these defense contracts create highly predictable multi-year recurring cash flows that insulate the business from broader market downturns. This brings us to a major commercial breakthrough that occurred this week, which serves as a prime example of why the general market perception is completely out of touch with corporate execution. The company successfully launched its first commercial deployment of an automated international shipping compliance platform with the Panama Transshipment Group. This is a massive global trade hub operator that handles millions of tons of cargo, and they are now using this specific artificial intelligence software to track inventory, optimize shipping routes, and automate security screenings in real time. This deal is incredibly significant because it proves the technology can seamlessly transition out of the strictly classified government sector and into highly profitable commercial logistics environments. Investors using the Interactive Brokers platform or scrolling through SoFi Invest often miss these quiet logistical rollouts because they are searching for hyped consumer applications. Yet these enterprise logistics partnerships are exactly how a small technology firm builds a highly scalable, high-margin software business. The intraday movement reflects a tight consolidation between a well-defined support level near $3.83 and a heavy overhead resistance line at $4.23, which the stock has just managed to break through during this session. This breakout is backed by rising institutional volume, suggesting that the smart money is beginning to build long-term positions rather than just trading short-term momentum. If you use online investing platforms or a Robinhood app to manage your portfolio, it is easy to get distracted by short-term price fluctuations and miss the deeper institutional accumulation. The broader sector momentum for defense technology has been accelerating significantly due to shifting geopolitical tensions and the urgent need for automated border enforcement, making specialized contractors highly attractive acquisition targets for larger aerospace giants. This institutional interest creates a strong floor for the share price as larger players look to absorb specialized intelligence software to bolster their own federal contracting bids. At this point, it is crucial to look at what this business actually does and how its core operational model generates revenue across both public and private sectors. Founded back in 1988 and headquartered in Virginia, the organization has spent decades building deep relationships within the United States Department of Defense and the broader intelligence community. They do not build generic chatbots or mass-market generative models. Instead, they focus heavily on data engineering, machine learning, and discrete event simulation for highly complex, high-stakes environments. Their systems take massive fragmented datasets from satellite imagery, shipping manifests, and digital identity profiles, synthesizing them into actionable
operational decisions where errors are completely unacceptable. By acquiring specialized entities like Pangiam, they have expanded deeply into digital identity, biometrics, and automated travel security workflows, which are now being deployed at major international airports and border crossings worldwide. Comment below how many shares of BigBear.ai you currently hold in your portfolio right now, or if you are planning to wait for a deeper pullback before buying. When you evaluate past performance and historical earnings reports, the financial statements reveal a company that has been aggressively cleansing its revenue mix, moving away from low-margin consulting services and focusing heavily on high-margin software licensing. In their most recent quarterly report, the company posted revenue of $34.44 million, beating consensus estimates and demonstrating clear structural growth. Although the net income figures then show a paper loss due to non-cash amortization surcharges and integration costs from recent acquisitions, the underlying gross margins are improving steadily as more customers transition to automated software platforms like the Ask Sage system. This shift toward clean, scalable software revenue is precisely what institutional investors look for when analyzing technology companies on advanced trading setups like the Interactive Brokers trading platform or specialized Fidelity Wealth Management dashboards. It shows a clear path toward operational profitability once the initial capital expansion phase for infrastructure deployment begins to level off. Looking closely at the future outlook, several distinct scenarios could play out over the next 12 to 18 months, each presenting its own unique catalysts and operational risks. In the most optimistic scenario, the rapid adoption of the maritime shipping compliance platform by other major global port operators could trigger an exponential increase in commercial software revenue, completely transforming the company's financial profile. This commercial acceleration, combined with the steady expansion of their federal defense backlog, would likely force mainstream analysts to re-rate the stock, driving massive retail interest across platforms like SoFi stocks and generic investing sites. Conversely, the primary risk stems from the highly regulated nature of government contracting, where administrative delays, budget disputes, or shifts in federal spending priorities can push expected revenue recognition out by several quarters, creating short-term liquidity pressures. Investors who practice self-investing must carefully weigh these long-term structural opportunities against the inherent volatility of small-cap defense equities. When you contrast the prevailing market expectations with the actual operational reality of this business, the mismatch becomes incredibly glaring for anyone paying close attention to the structural data. The market expects a fragile, speculative artificial intelligence company that is entirely dependent on speculative retail hype to keep its valuation afloat against a volatile tech market. The reality is a deeply entrenched defense contractor with a solid $282 million backlog, rapidly expanding commercial logistics partnerships, and a highly specialized suite of biometrics and identity software that cannot be easily replicated by mass-market software providers. This massive divergence between perception and execution is exactly where sophisticated investors find significant opportunities, quietly building blocks of shares via Fidelity investments or structured Robinhood investments, while the rest of the market chases overvalued mega-cap tech stocks. Ultimately, as the enterprise software market matures, the companies that survive and thrive will be those embedded in essential, non-discretionary infrastructure, making this specialized operator an incredibly fascinating study in expectation versus structural reality. Disclaimer: this video is for educational purposes only, not financial advice. Please do your own research before investing. Market involves risk. Like this video, comment your thoughts, share with your friends, subscribe for more updates.